friends, welcome to Nirmal and you're watching Power Talk Show, Minding Money with Money Managers. Today, joining us on the show is Mr. Raunak Onkar, Head Research of PPFAS Mutual Fund. Raunak, it's a pleasure having you on the show. And your funds have been doing really well. We were just discussing offline. Two funds we're talking about, the Flexi Cap Fund and the Tax Saver Fund. Again, they are doing really well. But let's first help us in understanding the sort of basic philosophy of the mutual fund, how basically sort of you go about your selection of the holding, the stocks. Help us understand the basic sort of theme and the philosophy.
Sure, Piyush. And thank you, Piyush and Nirmal Bang, for inviting me. It's a pleasure to be here and addressing all of you. And thank you, all of you, to take your time out and to listen to this. So what I will do, I'll just share my screen quickly. So this is a slide from one of our presentations. This is a very common presentation that we use to walk our investors or prospective investors through the entire group, the philosophy, the products that we have, and how we invest in them. And this slide particularly gives a very good idea, a very good overview of how we select companies to invest in our equity funds. Before I begin with this slide, there is a investment universe. And I'm sorry for those people who are joining who may not have been acquainted with PPFAS. In the Q&A, please feel free to ask about the background of the firm. If you have any detailed questions, I can walk you through that part also. But I'll drive straight into this point that before selecting any company, we need to maintain some sort of an investment universe. And in the investment universe, because we also invest globally, we have close to 700 stocks. Bulk of them, 500 of them, will be domestic Indian listed companies, and the remaining 200 are foreign listed companies from different geographies, not just the US listed companies, but also listed in other areas. So once you have this list, the main challenge is how do you actually navigate and understand all these companies? So, of course, 700 companies is a lot. It doesn't seem like a large number considering the 30,000 listed stocks globally, but 700 of good quality companies are filtered based on our criteria of quality, our criteria of profitability, our criteria of growth, and all these parameters. And once you filter with these parameters, we further filter them into different sectors. So we have a research team of about 8 people, including myself. And that research team gets these companies divided across various sectors. And each person is a sector specialist. That person will deep dive into that sector and help us understand how those companies work in that particular sector across the world. So to give you an example, if I track technology companies, I will not only track technology companies from India, but also which are part of our investment universe and listed all over the world. So this does a lot of interesting things. So once you start tracking just domestic companies, you essentially only are aware of the domestic ecosystem and how they behave in our markets. Whereas the moment you start tracking competitor which is listed outside, you start understanding the different nuances of valuations, different growth parameters. Because, for example, if a company like Infosys or TCS are listed in India, but their entire business comes from exports outside of the country, then you need to be aware of their competitors who are also exporting to the same markets. For example, Accenture, which is not listed in India, but competes head to head with TCS, Infosys, we need to understand how those companies also work. Similarly, an auto analyst in our team will track not only Tata Motors, Maruti, but also Suzuki from Japan, Toyota, Ford Motor Corp, and other listed auto companies across the world. That gives us a perspective about the entire sector and globally what is happening, and also helps us get a sense of how to value these companies from a different sector and different companies' point of view. Because when we are in our market, we only think what we value is the gold standard, but actually the world works in connected ways where capital flows and how companies can sell in different markets actually affect the way their cash flows can grow, their sales can grow over a period of time. So once we have filtered these companies across different sectors to our analysts, we follow this approach to further distinguish whether these companies are good enough to be considered as investment friendly companies, which can go in the portfolio or not. So the most important parameter for us has always been that the managements of the companies, the promoters of these companies should be minority shareholder friendly. Now, let me help you understand what does it mean. So being friendly to shareholders like us who don't have majority shareholding in the company's promoters and management should be very honest and should have good integrity in running the operations. So what I mean by that is, if there is any history in the company's past where the management has used the company's funds in an illegal manner, or management has wasted the company's funds by enriching themselves, or promoters have enriched themselves and led the minority shareholders by the wayside, we don't want to partner with such promoters and such companies. In fact, many companies' managements, by being competent and having integrity, can add significant value in the long term by just doing what they are good at doing and scaling the business and thinking about the business as a whole rather than thinking about enriching themselves. And there are several examples. So I'm not going to discuss frauds and other issues. These are very well documented, and we can watch endless documentaries about these. But essentially, the opposite of the frauds is what we're trying to find, where people have demonstrated good standards of ethics and also good competence in running that business, and also having some amount of competitive advantage because of that, because not too many companies are there whose managements are very friendly to minority shareholders. Secondly, when we are buying a particular stock in the stock market, our approach is not to just buy a piece of paper or something we are trading on the stock market. So our holding period is actually quite long. So if you see the fact sheet, the turnover ratio of this current fact sheet, and you compare that with, say, fact sheet from 3 or 5 years back, you will see turnover ratio has been very, very low for our equity funds. And the reason behind that is, when we purchase a stock, we actually feel like we are purchasing a piece of that business. We are not just buying a piece of paper which we can discard tomorrow if our mood changes about a particular company. So when we are entering, we do want to carefully assess why this company is good, and this business we are entering into is actually a real business in the real world, which does not change. Its value does not change every day just because the stock market says the value goes up and down, but actual business continues to grow. So we want to partner in this long-term cycles of business growth, and that's the reason we don't treat them like stocks. We treat them like part ownership in that business, like it is supposed to be. Most importantly, the point number 3 is, when you're purchasing these companies, we have already filtered some of these parameters, but the company essentially should be a positive cash generating business. And on the basis of that, they will also not need to borrow money from the outside world. So they will have low debt on their balance sheet. This is a very interesting phenomenon. So when you have cash generating companies, you'll automatically see the behavior of these companies towards wanting to generate more cash over a period of time. And of course, we have to be mindful whether the business will continue to grow or not, whether the company's existing business has enough competitive advantage or not, and that will sustain its cash generating capability. And the more cash they generate over a period of time, the more cash they can give back to their shareholders in the form of dividends or buybacks, or they can use that cash to reinvest in that business without lending their arms outside to say, please give me more money, through either diluting their equity or even borrowing money from banks or other lenders. So they don't have to borrow money from the outside world. They don't have to depend on the generosity of strangers to run their companies well. They have their own cash generation, which will allow them to keep on growing in their sector and their industry. I also mentioned competitive advantage. Here, not all businesses are made alike. So for example, some managements are very, very competent and they're extremely shrewd in understanding how to run that business well. And they have been doing it for a very long time. Some new managements who come into that sector might feel that it's easy to enter, but they realize suddenly that, oh, the competitors are so strong and dominant that it's very difficult to dislodge them from the market. Some new competitor might come in who actually might find a different way of running that business, which can affect the competitive advantage of the existing players. So we want to invest in companies who will not get easily affected by competition, who will not get easily affected by new entrants, who will not get easily affected by their own existing competitors. So that means that the company should have a very strong moat around it. The moat itself is like a river around a castle, which the enemies cannot penetrate very easily. But in a digital world, where these physical moats are very difficult to imagine, in a digital world, competition can come anywhere. So business models evolve, and the existing companies should also evolve their business models to match the competitors that are coming in. So most of the companies we track do have a plan in place to be competitive and to remain relevant to their customers. And that way they stay ahead of the curve out of the new companies that come in their industry or even their other existing competitors. And lastly, after we find all these characteristics, the point number 1, 2, 3, 4, 5, of course, the entire market also is studying these companies. So we are not unique in our understanding that, oh, we know something better than the market does. everybody studies the annual reports. There are analysts and investment managers who are brighter than us, who will also have their own views about these things. But the main interesting point is, despite knowing everything, are you really paying the right price for the stock? And over here, we are very, very discerning. We don't really go and buy just because we like all the other 4 parameters we have studied. We actually wait for the right price also. If that company is available at the right price, then we will buy. But if it is not available, we are perfectly okay to wait on the sidelines and stay on cash and find some other opportunity. So it's not necessarily that every sector will have great ideas available to buy, but there are times in the market where maybe last few days is an example where stock prices fall for no reason or some other reason which is not linked to the company that you're studying. And if the company falls, a stock price falls, the company falls, you can actually find that company trading at a very attractive valuation. And that's a good point to enter in those companies. Or scenarios like the COVID market crash, where of course the bounce back happened, but nobody knew when the market was falling that when the bounce back will come. Now in hindsight, we know that the bounce back happened, but when it is falling and you have a list of companies in your hand, which you know satisfy all your criteria for investing, I think that's a great opportunity to buy as long as you believe that the companies can still survive and sustain going ahead. So this is a basic idea of the investment process that we follow. It's a very, very valuation sensitive process. We don't want to overpay. We are very cautious about comparing the valuations with the bond yields of government bonds or other options available in the market, because investing is not in vacuum. It happens when you compare investment with other asset classes. So if you have an asset class like debt generating 7.5% per year, you need to have that equity also generating more than that, because equity, you are actually, I think, the lowest part of the ladder, where you are taking the entire risk of equity. If the company fails, you make 0 rupees. So if you're taking that kind of risk, you have to generate more returns than the debt. So the cash flow yield, the earnings yield has to justify that this company is available at a reasonable price and can continue to grow with high return on capital over a period of time. So that's our main criteria for filtering the companies we track. It seems like a very vague or very simplified criteria. It is simplified for helping to understand for the people, but at the same time, it is actually simple. It does not require too much of assessment of companies which are known to be good. So if you know companies to be good, if you track them for a period of time, if you have confidence about the business and you have built some conviction that this company is a very good company to own, then I think the only thing you should wait for is the right price, and it can come wherever you, if you're lucky, it comes sooner. If you're not lucky, you have to wait for it. So I'll just move on from this part to the FlexiCap fund. So as you all know that we have 4 offerings only. The primary fund that we started was the FlexiCap fund, the oldest fund in our portfolio. That is Parak Parak FlexiCap fund, started in May 2013. And the tax saver fund was started in July 2019. So we'll primarily talk about these 2 funds. So the whole idea behind starting a mutual fund actually came from the FlexiCap fund. So at that time, it was not called FlexiCap fund, it was I think called long-term value fund. But as the categorization has changed, we had to categorize this as a FlexiCap fund. The whole idea, so before this, PPFAS was managing a PMS. And in PMS, if you all know, there are restrictions of investing in foreign stocks. So we could not invest in foreign stocks. And plus, the structure was also a little bit tax inefficient, where even right now it is the same, where every transaction you make, the client has to pay a capital gains tax, long-term or short-term. Whereas in the mutual fund, if you put your money in the mutual fund once and you get the units, until you sell the units, you don't need to pay any tax as an investor. But the fund can keep on buying and selling stocks inside without the tax implication coming on the end investor. That is one way of structuring the mutual fund. We like that idea that we can actually, in our low churn approach, benefit a lot from the tax efficiency also. The idea was to create a fund that can actually go anywhere. So if we find value in a sector, it should be able to buy a company in the sector. If we find value in some different country, should be able to buy shares in that country also. And if we don't find value in anything else in equities right now, we should be able to sit on cash, sit on debt products, and we should be able to wait by the side to find the right time to enter into the market again. So it became like a Swiss Army knife. So if you know that multi-utility tool where it has a screwdriver, a knife, a cork, a wine bottle opener, everything in one tool, we tried to create a scheme which can do everything for the investor and provide requisite diversification. And I already mentioned to you that we have a very valuation conscious approach. So the philosophy comes from the school of value investing. If you would have heard Warren Buffett speak or Charlie Munger speak, the whole ethos of value investing, finding a good quality business at a reasonable price and then sticking with it throughout cycles, the whole philosophy comes from that. So it's a value investing oriented fund, which is a multi-utility tool, a Swiss Army knife for all the investors, where they can fit in all their needs within one fund, which reduces the complexity and choices for the investor. And lastly, it's a tax efficient fund where, as long as we are invested up to 65% in domestic stocks, the investor benefits from the tax laws of our country. So many people asked us when we started this fund, why are we investing in global stocks? And at that time, of course, nobody was doing it. So we looked like idiots trying to go out when India is a growing market. But of course, India is a growing market, and that's why minimum 65% of the portfolio is invested in India. But there are some advantages of going overseas. So I will just walk you through some of the advantages here. The number one advantage is the reduction of country-specific risk. So, for example, if in India there is a election result which the market does not like, the market tanks. If there is an INFS kind of a major financial market event, our market tanks. If there is a GST implementation which the market thinks is not the right way of doing things, the market tanks. So any kind of event which happens in our country, which is only limited to our economy, our stock markets react negatively to that event, or positively if the event is so. But at that time, nothing happens to global stocks because they don't care what happens in a country like India. It doesn't affect companies at a global scale. So the diversification really reduces some of the country-specific risk. If you also see some of the winning sectors and companies in the past 20 years, if you see a period from, say, dot-com bust, just 2001 till, say, the global financial crisis, the US market actually did not go anywhere if you see the broader indices. But in that time, India saw crazy bull run. So India had, I think, one of the best bull runs ever. Sadly, I was not participating in the market. I joined the market after that bull run ended. But if you see the next period, from say, the financial crisis till 2020, before the COVID crisis began, global markets did very well. So these winners and losers keep rotating. So it's not guaranteed that this 10-year period will be for some other geography. But because of the rotation, we can take advantage of some of these investment bets. So we don't have to be stuck with our market where nothing else but only our companies are there. We can also invest in other markets where the winners can keep rotating over a period of time. Third is, because of this rotating of winners and the country specific risk is being reduced, we also see the NAV volatility being managed to some extent. So we are investing good quality businesses with the same framework that we have in India. We use the same framework outside. So these good quality companies tend to be less volatile over a period of time. So the NAV volatility is also contained. At the same time, you tend to get a steady return over a period of time also. It is basically something you see in hindsight. So what we do is, if you go to any of the metrics available for mutual fund schemes on these tracking websites like Value Research or Morningstar, you will see a upside downside capture ratio or some other volatility metrics if you see. And those over a period of time will probably show that this strategy has worked in our favor. Another point is very interesting. So all of us, we are actually using American software to talk right now. We are using computers which are most of the tech components are not made in India, they're imported. We all use Android, iOS, smartphones. Most of these things are not made by Indian companies. They may be manufactured in India to some extent, but not made. The profits don't go to Indian companies. So if you really want to benefit from the global economy's growth, we need to find a wider choice. So if every time you do a Google search, Google makes some money out of it by showing you ads, right? So why not benefit by owning the shares of Google? Why not benefit by owning the shares of these companies which are outside of this country? So for example, we might use Amazon for our shopping and Flipkart for shopping, but the profits go to global companies. So why not own Amazon? Why not own Walmart? So the idea is that the choice of companies in India is limited because some of these companies don't exist in our listed space. So we are seeing some companies come up in the modern economy kind of stocks that are listed now, which represents e-commerce, delivery, all these companies, but they are nowhere at the scale and size and profitability of some of the global giants. So it's actually great to participate in those companies' profits also, and the fund can do it. So you don't have to do it separately. So the investor puts money in rupees and gets money out in rupees. The fund can then remit money outside, invest in those companies on the behalf of this scheme, and that's how you get the exposure to the foreign stocks also. So you actually open up your world to a very wide variety of companies out there. And last but most important point over here we found is that some of the companies listed in India, which are say subsidiaries of the MNC companies, say Unilever subsidiary in India is Hindustan Unilever, or Nestle has a company in India. So all these subsidiaries, 3M for example, another example over here. So some of these subsidiaries in India are actually very richly valued compared to their parents, whereas they only are exposed to the Indian markets and the Indian markets growth rate, but the valuations are such that it actually is amazing that they are sometimes 3 times more valuable than the parent company itself. And whereas the parent companies, if you see, they are not only exposed to our market, they get royalties sometimes from the companies which are listed in our market, but they also are exposed to overseas markets. So they actually are global companies where cash flow comes from global different companies in the different countries in the world, and they're able to allocate their capital more efficiently by doing buybacks or by borrowing money at very cheap prices as compared to what they can borrow in our country. So some of these advantages are there for the parent company, but the valuations are enjoyed by the domestic company. So we actually went out and found these companies which were trading at very reasonable prices. The same parent company of a company which is very expensive here. We thought that's a great idea to even do a valuation comparison and own a cheaper but better quality business than what we find in our country. So these are some of the reasons why we went globally. And of course, it's been a portfolio. So it's not going to be a static thing where this is the portfolio which is built once. We actually will have different companies coming in, going out, we'll make some mistakes. Some companies will do disproportionately better than the other companies. But the whole point is it all is part of the entire portfolio and it affects the NAV. Even the domestic companies performing well and not doing well affect the NAV in the same manner. So this is the idea behind the FlexiCap fund. Please hold on to your questions because I'll just quickly go to the tax saver fund so you can then ask these questions. Now, the tax saver fund is actually quite simple. Everybody knows the famous ATC enabled ELSS products that are there. So when we launched our FlexiCap scheme, most investors who have been invested with us for a while, they recommended to us that why don't we start a tax saver fund so that they can benefit from the same philosophy that we have, but they can also get tax benefit because they wanted to invest, really wanted to invest with our mutual fund house only. So we decided to create a product where we knew that the philosophy of the stock picking will remain the same. The only difference is that it will have a 3 years lock-in, which is mandatory by the ELSS rules. And also it cannot invest in global stocks. So if you see the portfolio, it will be almost 80-90% overlapping with the FlexiCap fund, where we could not buy the global stocks. You will see some of the domestic technology companies or some domestic names which are there. And interestingly, since the size of the fund is very small, you may also find some very small companies, small cap companies, which otherwise we could not have bought in the FlexiCap fund. So that way the portfolio has been built. It's a young fund. I think in any equity fund should minimum have a 5-year horizon. So please don't look at the return starting from 2019. I think it's a long way to go. And let's see how the fund performs over a period of time. With this, I will stop sharing my screen and let's do the Q&A so that people who have questions can get them addressed.
Right. So I think everybody can actually start putting their questions. And while actually we are waiting for the questions here, just a question from my side, and that would be Raunak. From a perspective of anybody who is listening to this webinar today, is listening to you from, I think from the numbers, I think the returns, the consistency has already been phenomenal. Again, one can look at the graph and everything. But when we talk about the stocks which are listed abroad, we're investing in them. And any thought on the currency risk? If there is any sort of participant in this webinar, they're thinking, will there be a currency risk? How the fund is managing it? Are the returns actually getting shielded by that? Now, please enlighten on that also.
Sure. So that's a very relevant question, Piyush. So definitely there is currency risk, and the currency risk comes in the form of the currency volatility. So what we have done so far is, although we may have, I spoke about companies listed all over the world, but the US market is so large, the stock market is so large that these companies have ADRs in the US market. So essentially like Infosys has the ADR of a same company listed in the US market. So you can buy Infosys shares in US as well as you can buy the same shares of the same company in India. So in the same way, there are other companies across the world who list their ADRs in the US market. So we have so far preferred to only invest through ADRs, no matter where the company is. So right now in our portfolio, we have a company called Suzuki Motor Corp, which is the parent company of Maruti. And they are listed in Tokyo as well as in the US in the form of ADRs. So we have purchased the ADRs. They represent the same company, but the way of buying them is through the US market. What that does is we limit our currency exposure to one currency, which is the US dollar, and we hedge up to 80% of that currency exposure. And what the hedging does for us is very interesting because there is a difference between the interest rate in the US and interest rate in India. We always have a premium. So when we hedge, we actually earn money. It's called a forward premium. Whereas if somebody from the US wants to hedge their exposure to rupee, they actually pay that premium. So every time we hedge, and we keep rolling over these hedges. So it's somewhere in the range of 70 to 80%. We try and hedge the currency exposure so that the currency volatility should not affect the portfolio performance. So the remaining part of the portfolio, which is like 20-30% of the US or global portfolio, that is exposed to currency, which does not have too much impact on the NAV. So yeah, definitely we hedge the currency risk.
Yeah, so that's an interesting clarity for everybody. I think let's wait for a couple of seconds for the questions from participants. Okay, so from the perspective, one of the basically the question is, as has been asked, is from the perspective of any sort of drastic fall in the markets, like those could be individual stocks, could be any news flow related events, like from that perspective, how actually does the fund actually react to that? Like, is it a very long-term planning? What is sort of usual planning on the stocks?
So we plan from long term. So like I mentioned, the pyramids that you saw earlier, all these characteristics are evident only in the long term time frame. So you cannot read 1 year's annual report and claim that the management is ethical or the company is very good or they have competitive advantage. You actually have to go back 10 years to see if the history is there of this company's performance doing very well, the management's ability to run this company well, and the sector also evolving in a favorable manner. So yes, the approach is long term for sure. And falls like what we are seeing currently in the market actually help us to buy companies which we like. So if those companies also fall in overall market fall, it's great for us. We can actually buy those companies and either increase the size in the portfolio or we add them as a fresh stock in the portfolio.
So fair to say conviction is for a longer time. And as you're just saying that any opportunity becomes a sort of favorable opportunity for you.
Yes.
And also from the perspective of there is any sort of a drastic fall in the market, or now drastic fall in our terminology could be like 10%, 20% for investors, or usually they also think about 3, 5, 6% is also a big fall. But on a calibrated way, if there is any sort of material fall in the markets, how the sort of fund reacts to that, and how basically you would advise our distributors are basically sort of participants in this sort of really look at that.
So I will answer the second part of your question first. In order to evaluate this fund or any equity fund for that matter, your investors who are getting into the fund should at least have a 5-year horizon for the money they're giving you. So if they don't have that 5-year horizon, just say no to invest their money in this equity product or any other equity fund, because these cycles in equity are a little bit difficult to predict. So cycles can sometimes play out in 3 years. Sometimes they might take 7 years. We don't know. Sometimes 5 years. So the average has been in the past that every 5 years we see cycles play. So if somebody is doing an SIP over a period of time, somebody is putting lump sum at one point in time, they really have to stick for 5 years to see how the scheme will perform, how the equity markets will perform in that period of time. And as and when their milestone comes of using that funds, because they've invested for some goal, then they can start withdrawing with a systematic transfer or systematic withdrawal plan. Just like the SIP, the opposite of SIP, you start removing some amount of money periodically, a few years or a couple of years before the actual goal starts, so that you don't get to, so for example, if something like the COVID thing happens and the market crashes dramatically at that time, and you needed the money in that month when the market crashed, it's actually unfortunate. So if you start withdrawing money before, you know that this money is required only 6 months from now, which is not a 5-year horizon. So then start withdrawing slowly over a period of time. That will help the investor stagger their withdrawals and not get impacted by sudden market falls. But what we do in the market fall scenario, we, like I said, we have a list of companies we track, and some of them are really attractive and we continue to buy them periodically in this fund. They're also part of the portfolio, but some of them which are not part of the portfolio, we are tracking them, we like them, they meet all our criteria except for the valuation, because they are very expensive on several of their longer term averages of valuation. So if those companies also fall because of the market fall, that's when we actually buy. Let me give you an example. So ITC is a company we've been tracking for a very long time. We love the consumer space. We like FMCG a lot because the business has stability and steady growth over a long period of time, and cash flow generation and no debt. It's exactly the kind of companies we like to buy. But the FMCG space, if you have seen in the past 5 years, the valuations are sometimes in triple digit. I think the average valuation is somewhere around 60 times, 70 times earnings. And that's a very steep valuation, and we don't like to pay those valuations. But ITC has been the reverse. It has all the benefits of a cash generating business like a FMCG company, but its valuations have been very low. So during COVID time, it became so low that it became very hard to say no, that this company we should not own. So as the price fell, we actually bought ITC. As prices fell, we bought Microsoft. As prices fell, we bought MCX, we bought IEX, we bought CDSL. Some of these companies we knew that we wanted to buy, but they were never available in the price band we were comfortable with. When they fell, we put them in the portfolio. So that's exactly what we do when, because we had some cash left on the side, our investors also gave us some money at the right time. We could deploy that cash and a portfolio could be built with the companies we like.
Absolutely. So that's something again which is a fund which is really focused on the valuation. So again, that's why you're saying again long term really matters here. So we're waiting for more questions here, and by then another question. I think from a research point of view, what's your view? And I'm just from our participants' point of view on a flexi cap fund. Markets have been slightly soft last year outside. We've seen some recovery now happening. So at present, are you actually looking to buy more sort of stocks overseas? Like, how do you balance it out between the temptation to buy Indian stocks and temptation to buy overseas stocks?
So let me give you an update to your investors. So last year, somewhere around February, the RBI came with a mandate saying that the Indian AMCs cannot invest globally anymore. There was a overall limit of $7 billion, which the AMC industry has exhausted, which the RBI had set in 08. So now that limit being exhausted, all the mutual funds like us who were investing abroad could not buy fresh dollars to buy companies there. So if you've seen the portfolio, so fact sheet of January ending last year, 2021, and Jan 2022, you see the fact sheets, you will see a dramatic change in the overseas investments. What you will see is something that was close to 30% of the portfolio is now close to 15% of the portfolio. And that has happened because we were not able to buy foreign stocks. Second thing that happened is in this time, the stocks that we owned also fell quite dramatically. So it was a good time to buy them, but unfortunately, because of regulations, we were not able to add more to the foreign positions. We still own them, and whatever dividends we earn from the existing investments, we reinvest. We are allowed to reinvest that, but we are not allowed to put fresh money over there. So in this period of last year, we have only invested in domestic stocks with whatever incremental money we had. And we also have about 12-13% kept in cash because we don't find our valuations to have fallen as much as global equity markets. So if you see all markets, European, American, any other developed country, the markets have fallen quite dramatically, whereas Indian markets have held on very strongly because we have very positive tailwind of opportunities ahead of us. And I think many companies are just valued at a very dear valuation. It's not very easy to buy a company where you knew that the long-term valuation has been so low and suddenly the valuation is taken to a level where it's not, you may not make any money if you buy at the current price. Like I said earlier, it's good to wait. Sometimes you have cash as an opportunity. If something like this, events like what we're seeing continue for a while and the market keeps falling, some good companies also are available. We can then buy those companies with the cash that we have. But from foreign point of view, yeah, the temptation is there to add more money there because they have fallen quite a lot and they are really good quality companies, but the regulations are holding us at bay right now.
Right. And another question again, basically, which is coming is on the tax saver fund. As we are in January right now, the best time actually to look at the tax saver funds here. So from that perspective, what's the sort of message and also a sort of I won't say industry comparison, but from a perspective of our tax saver fund, what is sort of messaging on the tax saver fund, and how actually our participants should actually really sort of take the message home?
Sure. So firstly, just because it's January does not mean you should invest in tax saver funds. Tax saver funds, you can have SIPs running throughout the year. I think tax saver funds do a very good justice to the investor who is a small investor. They can actually exhaust their ATC benefit and take the full advantage of that limit which is there. However, the tax saver fund that we manage is actually exactly similar in terms of philosophy, like the FlexiCap fund, minus we don't invest in global stocks in that fund. Secondly, it has a lock-in of 3 years. So people should have, anyway, if you have a 5-year horizon, that doesn't matter. The lock-in for 3 years will take care of itself. But if you want to invest in foreign stocks, this fund is not for you. Tax saver fund is for you if you only wanted to, say, invest in domestic stocks and you meet your ELSS requirements, then this fund is for you. Although you don't have to limit yourself to the ELSS requirement, you can actually invest more also. It's like a normal mutual fund, and the 3-year lock-in actually is a good barrier, so that if the market falls and you're tempted to take money out because of fear, you're unable to do it because the fund will have a lock-in. So I think from that point of view, you should treat it like any other mutual fund, equity mutual fund. Make sure that the holdings that we have do not overlap with other holdings of other schemes that the client might have in their portfolio. So if you see the same stocks being large proportion in all the schemes, then they may not get the benefit of diversification. So we try to meaningfully deviate from the market. We don't actually follow the same exchange benchmark criteria of portfolio allocation that we have. For example, if benchmark has something in finance, some percent in finance, some percent in pharma, some percent in technology, we don't try and follow those metrics. We just buy companies we like, which fit in our philosophy, and we allocate some money in the fund to them. So if you see some of the holdings, sectoral wise, you mentioned finance earlier. So finance also has different kinds of companies. One is lending business, non-lending fee businesses. So we try and differentiate between all of them. We don't try and build a portfolio just of lending companies where the index might have a larger holding in that. So we try and deviate from the benchmark a little bit. But on the other side, treat it like a normal equity fund, have a long-term horizon, and make sure that there is not too much overlap of top holdings in your clients' portfolios.
Right. If anybody wanted to identify the FlexiCap fund, is it fair to say it is largely a large cap fund?
So far, it looks like a larger cap fund because if you consider even the global stocks, they are actually mega caps. So including them, yes, it is having a large cap bias because that's where we find the value. So if there was value or attractive stocks available in mid and small cap, for sure, it would have more focus towards mid and small caps. But if you see the companies, number of companies, there are a lot of companies in there which are fitting in the mid and small cap list also. So if you see the capital market subsidiaries, the AMC businesses, then if you see these a couple of pharma companies, those fit in the mid to small cap kind of a category which is there. So it's not necessarily a large cap.
You want to talk about any stocks?
Whichever you want to talk about. So the fact sheet is in front of you. You want to pick up any stock you want to discuss, we can go into it briefly.
Yeah, like within the FlexiCap fund, I had observed a couple of holding company names also. So why do you like the holding companies more? Is it primarily because of the valuations? Like so, there could be Bajaj Holdings. I think they've already taken the names. I won't say about that, but we've also seen a couple of holding companies. So any reason for bias in that?
So holding companies, we primarily like the Bajaj Group holding companies because by buying Bajaj Holding, you get a piece of Bajaj Finserv and Auto underneath it. And if you buy Maharashtra Scooters, you get a portion of Bajaj Finance directly. So what it does is you basically buy the same underlying stocks at 50% discount or 60% discount to the valuation. So that gives you some cushion, plus the dividends flow through directly to you. Whatever dividends come from the underlying companies, they flow to you. So the dividend per share is different for you versus if you just buy those companies at individual shares of those companies. And over a period of time, as the underlying companies keep doing well, the valuation of the holding company is also shown to do well. And periodically, the discount between these underlying companies' value and the holding company's value, it shrinks. So right now, it may be somewhere close to 50%, 55%. At some point, it widens, was about 65, 70%. At some point, it goes lower than 50%. So that continues to happen. But anyway, we are basically investing in the underlying companies at a discount to their current market price. That's the only theme to look at here from holding companies' point of view. And although there are several other holding companies, we don't like all of them the same way. We like the Bajaj Group because they have had a disciplined execution over a long period of time. So we prefer only those holding companies.
Right. And what's the view on the technology and why actually you've been liking the stock which you're holding?
So in tech sector, so a lot of times people paint the entire sector with the same brush of technology, but actually there's a variety of companies in there. So if you just look at the Indian IT companies that we own in the portfolio, HCL Tech or even Oracle Financial Services, if you see those companies actually are IT services, IT product companies which are running out of India. If you see companies like Microsoft, they're actually enterprise software product companies which sell all over the world, and products are very well known to us. It's Microsoft Windows, Office, etc. Then there are companies like Google, Facebook, which actually are, I think, the largest market share companies in digital advertising. So every time we open Instagram, we're actually looking at a Facebook or a Meta product. Every time we do a Google search, we're actually using a Google product. So all these companies, and Amazon, for example, it looks like a retail company, but actually there are several companies underneath it. The retail businesses is one part. There's a marketplace business. There's a cloud computing business. So there are several technology-enabled companies around with that. And that's how we build a technology portfolio, although it is labeled as technology because the labels are regulatory labels. They classify all tech companies together. But actually, if you drill down into the business models, they have very different cash flow metrics, very different growth metrics, and very different industry outlook. So IT services company would be more or less stable over a long period of time in their cash flow generation because they have customers' needs which are already known to them and they cater to those needs. Whereas a company who sells enterprise software will have to keep selling new enterprise software or licenses or subscriptions to make sure that they keep making money. A cloud computing player needs to assess cloud computing demand of all enterprises in the world. When they're shifting from their own servers to the cloud, they will have to anticipate that demand and grow in that area. Digital advertising, again, it's a very wide and huge portion of advertisers. It can be Procter and Gamble size or HUL size advertiser, or even a small school teacher in your neighborhood who might buy a Google search ad. And if you search for tuitions in your neighborhood, that ad will come up in the Google search. So it's a wide variety of advertisers who are advertising. So these are very different businesses if you separate them and try and understand each of them separately. But if you look at them as a bunch of technology companies, we like them because the opportunities are so different and so varied and so positive. So despite the size of these companies, they still have enough room to grow. If you see search as a product, now people are debating whether it's going to be AI driven search or whether it's Google search. So that debate also is now getting the search market more excited. If you see some of display advertising, there are not too many apps which make money. And for example, any people in the audience who have people who are, say, below the age of 30 in your house, just check how much time they spend on social media, how much time they spend on their mobile devices, how much time they spend on digital interfaces or screens, basically. And then you realize the importance of display advertising, that if they are spending so much time here, they're not spending much time reading newspapers, they're not spending time reading magazines, they're not watching regular TV like we used to do when we were kids. You know, at a certain time, we'll go and watch something. Now it's all on demand. So if you're on an on-demand platform, you have to adapt your advertising to reach their audience. And this younger generation is growing to be in their income generation phase, who will be consumers growing from here. So if you want to tap them, if you want to address that market, you have to go where they are. So that audience is in digital arena, and digital advertising becomes a very important part. So if you drill down all these metrics into technology companies, it's actually quite fascinating to see such a varied cash flow available to us, and we can invest in India, globally, all over the world.
Yeah, so exciting answer on that. Absolutely. And lastly, sort of any other sectors where right now, even like from a fund point of view, I'm just saying a backseat here, and we are talking at an interesting point. There is a budget right around the corner. So any two words on the budget, and I think it will be beneficial for all the participants who are watching you right now. So as an institutional sort of fund, how we're looking at the budget and how it is important really to plan for investing into the funds and also for your own fund.
So the sectoral side, another sector which we have been investing heavily in over the past few years has been the private sector banks. And in private sector banks, specifically the top three banks, HDFC, ICICI and Axis. Now, Kotak could also make in that list, but Kotak has always been richly valued as compared to them, all the other ones. So it did not make a cut, although we like that bank also. If its price is available at a reasonable valuation, sometimes you might see that in the fund also. So private sector banks, if you see over the past few years, if you just take a decadal view, they have been taking market share from public sector banks. on many areas. So not just on deposits and loans, but also the entire cycle of credit has benefited the private sector banks more, because the public sector banks have had their own issues. They have had mismanagement, they have had bad loans, whereas private sector banks have been slightly more disciplined, more shareholder focused, and they made sure that they will not make too many mistakes. They also have made mistakes, don't deny that, but their mistakes have not been as large so that it will affect their future growth completely. And now they have realized that the size that they operate, they have become very good consumer franchises. So everywhere you go, you can easily identify a Kotak or Axis or ICICI, HDFC. You don't need to advertise to customers to make sure that these are trustworthy brands. And it's very interesting that once you have that kind of trust built in system, it becomes very easy. If you want to open an account, you don't have to think twice whether this bank will be there next 5 years or not. So of course, the trend going towards larger bank, the economies of scale have really helped some of the private companies, and they have also enabled themselves technologically. They have invested in technology. They have made their apps better. They have made more feature-rich apps where people can actually use banking apps for other things also, not just for doing banking work. So that is one part of the sector which we like, banking space we like, the private sector banks. From budget point of view, really the budget has been like a event. Of course, we watch it and we read about it, but on the day of the budget, nothing much happens. I mean, most of the things are anyway in the market. One, I think, interesting point which the budget is teasing this time is whether the capital gain structure is going to be uniform across different asset classes. So we are looking forward to coming up, whatever comes up. It's very interesting to see how it affects different asset classes if the capital gain structure is uniform across, say, real estate or equity or debt. That is one expectation, but we don't know. So GST, I mean, indirect tax was part of the budget, but now it's part of GST, so it doesn't really matter what happens in the budget. But yeah, it's an event which everybody anticipates and likes to talk about. I don't have anything specific to add about the budget because it is really a non-event from a very short cycle, annual cycle point of view. Because see, the budget is anyway going to happen. The country will make money through taxes, through other means, through disinvestment. They will have allocations to other sectors. They will announce some schemes where the different sectors which have been downtrodden might get uplifted because of that. And that's it. I mean, this is basically a event where allocation of money happens based on whatever you've earned. And all the metrics are anyway out there. So we know what the fiscal deficit is. We know all the metrics already. So it doesn't really matter what the budget actually says. But some of the interesting things can come up, which is very surprising if they actually make the capital gain structure uniform for asset classes. We don't know the impact of it, but it's interesting that some innovation happens, which is different from other markets. That is one. I think that is all. If you have any other questions, I'm happy to answer.
No, I think we have covered absolutely all aspects from stocks to your budget views and everything. So I would say, I think there are no further questions. I think we have covered everything. So Raunak, I think you've been kind enough to explain everything to our participants, our viewers on the show. I think all the best wishes to you and the PPFAS fund team again for carrying out this good work. It's absolutely a unique way where you're not taking a look at the index, you're actually taking a look at the quality of the stocks, the mode perspective, cash flow generation perspective, and perhaps that's the message I think which our participants will take home. So thank you a lot for participating in the show.
So thank you, Piyush. It's very well summarized. I couldn't have summarized it better than you. And thanks to all your audience also who have been here for an hour or more. And if you have any further questions which were not addressed today and you were not able to ask, please reach out to Nihal and Mahesh from our team. They'll be happy to address those questions for you. Thank you so much.
Thank you. With that, it's a wrap on this webinar, this show. Thanks a lot for watching us.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.